Let's move on. In this video lesson, we'll focus on the firm's financial environment. The thing is, any business interacts continuously with its economic and financial environment. Previously, in the very beginning of the course, we have studied firm's economic environment. We have learned that the business is affected by numerous forces from outside of its control: consumers, competitors, suppliers, labor market, capital market, various actions by the government, and international economic environment as well. We have learned some of this during the first part of this module. Now let's look at the business and its operations from a slightly different angle. Let's have a look at the firm's financial environment. Financial environment in which the firm operates is a part of an economy where the major players are financial markets, financial intermediaries, and investors. Investors are individuals or businesses which provide capital to others, to borrowers, for financial returns on their investment. Financial intermediaries are entities which act as middlemen between two parties in a financial transactions, between buyers and sellers of financial instruments. And financial markets represent the part of the financial environment which make all these transactions possible. And of course, there are some other factors which can influence the company from financial point of view. You will study this in other modules in more details. Let's focus on financial markets first. Financial markets include all institutions and procedures for bringing buyers and sellers of financial instruments together. There are various functions of financial markets. First of all, it's of course mobilization of savings. In other words, spare funds which are available in the economy are made available where they're needed. Apart from this, financial markets facilitate price discovery. In other words, they allow price to be established via the interaction of demand and supply. We have studied this in a lot of detail in the first part of this module, where we learned how combination of demand and supply allows the market to achieve equilibrium price in particular to be established. This is what financial markets do as well, like any other type of the market. Financial markets also provide liquidity where it is necessary, for example, to purchase various assets. And very importantly, financial markets reduce the cost of financial transactions. We will come back to this in a few minutes. Well-functioning financial markets are hugely important for the performance of the national economy. This is because they facilitate the flow of capital from investors to the users of capital. Markets provide savers with returns on the money they saved, and apart from this, they can provide a source of passive income if you invest for longer term. For example, in a pension plan, you will be able to live on the return from your previous investments, on your previous savings, which you've accumulated over your lifetime, hopefully after your retirement for many, many years. Apart from this, markets provide users of capital with necessary funds in order to finance their investment projects. Because of this, well-functioning financial markets allow to expand the production potential of the economy, to shift production possibility curve to the right, and therefore promote economic growth. They allow the national economy to produce high level of output, increase employment level, reduce unemployment, and therefore achieve other macroeconomic objectives. And that is why economies with well-developed and well-functioning financial markets perform significantly better compared to the countries with poorly functioning or underdeveloped financial systems. There are very many different types of financial markets and many different classifications of those markets. For example, we can separate primary and secondary markets, or money market and capital market, organized exchanges versus over-the-counter markets, spot and futures market, forex markets, commodities markets, and many others. Let's cover briefly what all of these concepts mean. First classification: primary versus secondary markets. Primary financial markets are open to selected investors who buy securities directly from the issuing company. These securities are considered primary offerings or initial public offerings, so-called IPOs. When a company goes public, it sells its stocks to large-scale and institutional investors such as hedge funds and mutual funds. while secondary market, on another hand, is where existing or already issued securities are traded between investors. For example, the New York Stock Exchange and Nasdaq are examples of the secondary stock markets. Let's have a look at the different classification between money and capital markets, what exactly these concepts mean. Money market is a wholesale market for trading short-term financial instruments with a maturity which is less than 1 year. This includes overnight reserves, US Treasury bills, commercial papers, bank certificates of deposit, and similar financial instruments, usually in large volumes. It's a highly liquid market with minimal risk. On the other hand, a capital market is where a broad spectrum of longer-term tradable financial instruments are purchased and sold, with a maturity which is longer than 1 year. It is generally used to secure long-term financing for capital investment. We can separate capital market into numerous other types, for example, stock market, bond market, derivatives market, and so on. Stock market is the largest portion of the total volume of the capital market trades. Stocks are held by both private and institutional investors. Other types of tradable instruments, for example, bonds, derivatives, and so on, are preferred by insurance companies, pension, and hedge funds, in other words, professional investors. Apart from this, there are other types of markets, for example, foreign exchange market or forex, where you can buy and sell foreign currencies, commodities market, gold, oil, steel, wheat, etc. Financial markets can also be located in organized exchanges with a physical location, such as London Stock Exchange, or function as an electronic over-the-counter market, which is a decentralized market with a network of dealers in which market participants trade directly with each other without any central exchange. Over-the-counter markets do not have physical locations, instead trading is conducted electronically. Another classification which we can consider is spot versus futures market. Spot market is where assets are bought and sold for the spot delivery, in other words, immediately, while futures market is where participants agree today to buy or sell an asset at some future date at a predetermined, pre-agreed price. So this is a brief introduction to various types of financial markets which you can come across. Now let's look at types and role of financial intermediaries. In finance, funds can be transferred between those who have them and those who need them directly or through an intermediary. And financial intermediary is an entity which acts as a middleman between two parties in financial transactions, such as a commercial bank, investment bank, mutual fund, or a pension fund. They help to channel savings into investment, facilitating economic prosperity and growth. Apart from this, financial intermediaries fulfill some other roles and offer a number of other benefits to an average consumer, including safety of transactions, providing liquidity to financial markets, reducing transaction costs to their clients due to the economies of scale involved in banking and asset management. They help to spread risk through diversifying portfolios, and so on. There are numerous types of middlemen operating in financial markets. Let's go through a few of them. First type of financial intermediaries are brokers, which are agents which fill financial orders for their clients. They might help to reduce transaction costs of financial deals, as they can match clients willing to buy or sell certain financial instrument to someone who is willing to take another side of this trade. The second type of financial intermediary is the asset transformer. These are entities which help to turn something into an asset or changing the shape of an asset. For example, a bank can use its individual clients' deposits or mobilized funds and pool them to make loans in order to generate revenue. They are transforming their own liabilities, deposits, into banks' assets, new loans. This type of intermediaries can deal with risk, maturity, denomination, or volume transformation of assets. For example, a financial institution can have, let's say, a 10 million bond, but cannot find customers willing to buy it. What they can do? They might slice it into smaller chunks, say £1,000 worth each, and sell them individually. They've repackaged this bond and transformed one type of an asset into a different one. Or they can attract funds for a certain period of time, for example, saving deposits for a long term, say 3 years, and lend them to borrowers on a short-term basis, for example, overnight. This would be an example of maturity transformation of an asset. The main types of asset transformers are commercial and investment banks. Another very important type of financial intermediary are stock exchanges, which of course facilitate trading in various securities and other financial instruments. Apart from this, you can come across mutual funds. These are the funds which pull together shareholders' capital, invested, for example, to buy stocks or bonds or derivatives, and actively manage this portfolio for their clients. Financial advisors provide expert advice and offer additional guidance to anyone involved in financial transactions. And insurance companies can also be considered a type of financial intermediary because they help to secure businesses against various risks. They pull together insurance premiums, accumulate funds, and pay for claims when necessary. Apart from this, there are numerous other types of financial intermediaries operating in financial markets: credit unions, pension funds, hedge funds, saving and loan associations, and so on. The banking sector is probably the most well-known and largest type of financial intermediary, and retail or commercial banks is the most prominent type. They accumulate customer deposits and provide loans to their retail and business customers. These are normal high street banks which serve general population to satisfy their banking needs. Retail banks may offer a number of other services to their customers. For example, they manage customer current accounts, make regular payments, for example, to pay bills. They help customers to transfer money abroad, provide investment and pension plans, insurances, and other financial products. They can even offer notary services. These are retail banks. Apart from retail or commercial banks, the banking sector also includes wholesale banks, which fulfill a number of other functions. They help to raise external finance for companies, for their clients. They provide brokerage and dealing services. They help to manage companies' assets. They help to provide assistance in corporate restructuring and also help to manage risk using various derivatives. The banking sector also includes international banks, which provide foreign banking and euro currency trading, building societies, finance houses, and so on. Again, very many different representatives, very many different entities which operate in this sector, in this part of the financial market. All these financial intermediaries which we've mentioned fulfill a very important role in the economy. The thing is, in a well-functioning economy, capital flows efficiently from those who supply it to those who demand it. There are two sides involved in the capital allocation process: suppliers of capital, or savers, and demanders of capital, or borrowers. It's very similar to economic demand and supply model, where we have consumers and suppliers. As we've learned from economics, consumers and suppliers have different preferences, conflicting preferences. In fact, consumers prefer to buy more at lowest possible prices, and therefore the demand curve is downward sloping, while suppliers of any product prefer to sell at the highest possible price, and therefore supply curve is upward sloping. And an interaction between demand and supply establishes an equilibrium and helps to determine an equilibrium price. We can apply this model to any market: a market for apples, a market for gold or oil, or money market. For example, if we consider that this is a money market, we have a downward sloping demand for money, upward sloping supply of money, quantity of money in circulation located along horizontal axis, and price of money or interest rate located along vertical axis. Or similarly, we can apply this model to, let's say, stock market, where demand and supply of stocks will determine share prices of various companies and the volume of trade, the quantity of stocks purchased and sold during a certain period. So economics tell us that there are conflicting preferences of consumers, users of a certain product, and its suppliers. A similar thing happens in finance. Suppliers of capital, or savers, which represent the supply side of the market, suppliers of capital, are individuals and institutions with excess funds. These groups are saving money and they are trying to get the highest possible return on their investment. They try to sell their capital at the highest possible price. On the other hand, demanders or users of capital, borrowers, are individuals and institutions who need to raise funds in order to finance their own investment projects. And these groups, of course, are willing to pay a certain rate of return on capital which they borrow, ideally the lowest possible rate which they can get, the lowest possible price. And interaction between them will determine equilibrium. So therefore, demand and supply model clearly shows that savers and borrowers have conflicting preferences. However, there is another aspect, another dimension to this. The thing is, savers, which are usually households, want to exchange any surplus cash which they have for financial assets with highest possible liquidity and lowest possible risk. They want to be able to get their money back if necessary. They want to be able to sell these assets as quickly as possible with the lowest possible transaction costs, which mean that they prefer highly liquid instruments. And of course, they don't want to take unnecessary risk. And apart from this, savers frequently have small amounts of cash at their disposal, while ultimate borrowers, which are usually companies, business sector, they aim to maximize shareholders' wealth by investing in real assets, not financial, but real assets, and often for longer period of time with uncertain outcomes. In other words, they frequently deal with instruments with low liquidity and high possible risk because the outcome is not known. They don't know whether their investment project will be successful or not and how much revenue and profit it will generate. It involves higher risk. And apart from this, borrowers frequently need larger amounts that an individual saver can have at their disposal. So two sides of the financial market will have different conflicting preferences. And the next diagram helps to illustrate these conflicting preferences. We have here private investors or households which prefer high liquidity, low risk, and have small amounts of funds in their disposal. And the second group, ultimate borrowers or businesses, which invest into projects with low liquidity, high risk, and usually large amounts of money are involved. If an economy operates without financial intermediation, channeling savings into investments due to these differences in preferences will lead to high search, high agreement, and high monitoring costs of every financial transaction. In other words, it takes a lot of effort and time to find a suitable counterparty who would agree to deal with you on your terms. And then there will be high costs involved in monitoring whether they actually obey the terms of the deal you've made. On another hand, in a country with financial intermediation, which includes brokers, asset transformers like commercial banks, and well-developed financial markets, this process of transforming or channeling directing savings towards productive investment is much smoother and more efficient. Borrowers or businesses which need funds for investing purposes simply issue and sell securities, shares and bonds, while asset transformers will offer possible buyers securities with risk, return and maturity characteristics which they require. And as a result, search, agreement and monitoring costs are significantly reduced, while the volume of transactions and therefore amount of funds which can be effectively used for investment purposes increases dramatically. Therefore, society in countries with developed financial systems benefit, and its wealth increases too. So these are the main types and roles of financial markets and financial intermediaries. And in the next lecture, we will focus on the firm's financial objectives, different types of business organizations. I will also introduce you to basic concepts related to corporate governance, and we will also learn the agency theory, which studies so-called separation, or sometimes called divorce, of ownership from control. This is what we'll do in the next video lecture.